Welcome and thank you for joining us. It's my pleasure to introduce Anthony Cambeiro, President and Portfolio Manager of Anthology Capital. A graduate of Wharton, Anthony's been in the investment business for more than 10 years, getting his training within the small cap value team at BlackRock, as well as at Downtown Associates, a $300 million value-oriented hedge fund in Pennsylvania, where he served as co-director of investments. In 2011, Anthony founded his own firm, Anthology, which is a long-short equity fund. Having met Anthony before, I'll tell you that he's a very thoughtful person and a smart investor, so I'm really looking forward to his best idea that he will be sharing with us here today. And with that, Anthony, please take it away.
Well, thank you so much for the kind words, Oliver, and I'm honored to be here presenting at the Best Ideas Conference. As Oliver said, my name is Anthony Cambeiro, and I'm the president and founder of Anthology Capital. Quickly, the disclaimer here, which I'm sure you're dying to read, it just says that we're providing some information, not a recommendation to purchase any security, and it's not a solicitation to invest, just that can only be made through a private offering memorandum. So with that out of the way, I'd like to first tell you about the fund. As I mentioned, we launched the fund on October 3rd, 2011. I had been at Downtown Associates, a $300 million hedge fund where I was a co-director of investments, and I left there at the end of 2010 after 10 years to launch Anthology. So at Anthology, we run a value-oriented long-short equity strategy, and the core focus is to find high-quality businesses, which are companies that generate strong returns on invested capital and are run by honest and capable managers. But we want to find them when they're underfollowed or under some kind of temporary distress. And there's usually a reason that we're getting a great deal. We look across market caps and industries, but we tend to focus on the smaller, less efficient side of the market. And then we build a concentrated portfolio of around 15 names with a portfolio construction policy is to try to have around our top 3 positions be around 9% of the fund, the next 3 positions be around 7% of the fund, and so on. So it's fairly concentrated in the top names. The range of the position sizes is around 15% on the high side to around 3% on the low side. We'll hold cash if we can't find something intelligent to do rather than feel compelled to always be fully invested. On the short side, we're looking for really the inverse of our longs, companies that are low quality, declining businesses, but are fairly expensively priced. But we do this in a much more diversified manner and have smaller position sizes on the short end. We do run 2 complementary strategies to our core. The first, which we call special situations, or kind of workouts. These are really off the beaten path ideas that have a very attractive risk reward and a more immediate short-term catalyst, but may not have the same characteristics of our core long portfolio. And then finally, we'll use a variety of instruments to reduce our net exposure during periods when we think the market risk is high. So the core elements of our approach, we touched on some of these points on the prior slide, but one of the keys to the approach is that we take a long-term time horizon when we're evaluating a business. We think that's one of the advantages we possess in the short-term oriented market to take a longer-term approach. We're looking for investments that can return multiples of our cost over the next 3 to 5 years rather than try to find something that could just go up 10% next quarter. We do take a very bottom-up approach. Our goal is to find the key factors that will drive the business over the next few years and why the company has an advantage over that period. And we go well beyond reading the Ks and Qs and other filings. We really try to tap the network we built over the years and speak to individuals across the industry. And finally, we concentrate our effort, our time, and our capital into those ideas that we feel are the most attractive. So the theme of this presentation, I like to have a theme for my ideas, and the theme of this presentation is really about market share and how a company can pick up a significant amount of market share fairly easily. And to help illustrate this concept, I'm going to start with an analogy. So this story involves 4 friends and a pizza. The 4 friends are Charlie, Sam, George, and Isaac. And they've been going to the same pizza shop together for years and always order 1 large pepperoni pie to split. And the pie has been split the same way for many years. Charlie is a very big guy. He would always take 4 slices. Sam has also been around for a while, and he's pretty big. He grabs 2. And George and Isaac are newer members to the group, and as a result, they only end up with 1 slice apiece. Now, they're very hungry. They could eat more than 1 slice, but at this point, all the slices are gone. So that's where things really would stand and stood for a while, but things are changing. One day, Sam decides he really doesn't like eating pizza anymore, and he leaves the group and leaves his 2 slices of pizza on the table. So those 2 slices are now up for grabs. And Charlie, he's a big guy. He would love to eat those 2 slices, but unfortunately for him, his wife won't let him. She nagged him all the time that he's so overweight. And so as a result, it seems that he's kind of capped at 4 slices. So that begs the question, who's going to take the 2 slices that Sam left on the table? Well, this is the moment that George and Isaac has really been waiting for. They could each quickly grab 1 additional slice without much effort. They don't have to fight Sam over it. He's gone, and Charlie, his wife, is preventing him from eating anymore. So as a result, all of a sudden, George and Isaac are now eating 100% more slices than they were before. So I want you to keep this concept in mind as we talk through this idea. When a large player exits the market and the biggest market share guy remaining is capped and can't eat anymore, the smaller remaining players are the primary beneficiaries. So that brings us to the idea that I want to talk about today, and that idea is GSI technology. The ticker is GSIT, and as you might have guessed, GSI is the George in our pizza story. But this company has nothing to do with pizza whatsoever. Their business is to design SRAM memory chips, and I'll explain more about what those are in a couple minutes. But first, the high-level details. It is an approximately $160 million market cap company with a 5 3/4 price as of the date that I made this presentation a couple days ago. There are about 27.5 million shares outstanding. The company has a very strong balance sheet with $90 million in cash and no debt. They have a long track record of profitability with over 35 consecutive profitable quarters. For the last 12 months, the company has generated around $75 million in revenue and $10.5 million in adjusted pre-tax operating income, which exclude legal expenses, and I'll explain why I think that's appropriate. And those 2 numbers, the revenue and EBIT, operating income, we think are temporarily depressed for a couple reasons, and we'll get into that later in the presentation. The gross margins for this business are quite healthy in the mid-40% range, which demonstrate that this is not really a commodity product. In its peak quarter, the company generated 25% operating income, operating margins. Even in today's kind of what we think of the depressed earnings level, the company still is putting up a rolling 4-quarter return on invested capital of around 25%. Importantly, the 25% of the company is owned by insiders, management team and the board. We really like to get involved in situations where the managers are aligned with us and they think like owners, and we think we have that here. The current valuation at 6.5 times EBIT, enterprise value to EBIT, is attractive. And finally, it's the number 3 market share player with about 8 or 9% of the market in the SRAM memory chips. So what do they do? What is SRAM? So SRAM is a memory chip. It's quite similar to DRAM memory, which you might be more familiar with, but it's very different in some important ways. DRAM is really a commodity product. It's used primarily in computers and some other consumer electronics. SRAM is significantly faster than DRAM, by orders of magnitude faster. And as a result, it tends to be used in markets where speed is of paramount importance. There is a trade-off for that faster speed. They tend to be less dense in terms of megabytes than DRAM, but speed is core. The markets where SRAM tends to be used are in the telecom equipment market, things like base stations, switches, routers, servers, fiber channel storage, things like that. There are a couple pictures there of Cisco and Alcatel switches. There are also several military applications, as well as some industrial and automotive applications where the needs of the application can only be met with SRAMs. DRAMs can't do the job. So on the left there you see the 3 GSI chips. There's really not much to see because all the neat stuff is buried in the design. But if you do have any questions around the SRAM market, I'm happy to take them in the Q&A. Through conversations we've had with some players in the industry, we estimate that the total addressable market is around $850 million to $1 billion today. So it's a relatively small niche in the total semiconductor industry. It's a much smaller market than even the DRAM industry. On the whole, we think it's a slow growth market at GDP plus or minus, but at the high end, the most demanding applications, the most demanding SRAM chips tend to be growing a bit faster. The market's split today between 4 main players. There are a few other guys, but these are really the main guys. Cypress has 40 to 45% of the market, Samsung 18 to 20%, and GSI and ISSI, Integrated Silicon Solutions, each have about 8 or 9%. ISSI tends to be very strong in the automotive and industrial sectors and kind of on the lower end chips. Cypress is across the board. They have market share at the low end as well as the high end. Samsung's more concentrated in the higher end and in the telecom military market. And GSI is also focused on high-end chips in both the telecom and military applications. Today, the military market represents about 10% of GSI's revenues, with the remainder primarily in the telecom equipment market. So a few other important points to keep in mind about this industry. The end products that SRAM chips go into have very special and unique design requirements. A Cisco router is designed in such a way that it may have a very different need than a Alcatel might need in one of their switches. So the SRAM that's designed for a Cisco router is going to be a different SRAM than is designed for an Alcatel switch. And so as a result, there's not really a commodity SRAM like there is in DRAM, which all DRAM is more or less the same. So there are hundreds and hundreds of different flavors of SRAM, and each one of them has relatively low volume. So as a result of that, there tends not to be these big inventory builds like you see in the DRAM industry, and pricing in the SRAM market tends to be very stable and a very predictable, stable decline curve. Once a product is designed in, it stays in, and some of these router servers and some military applications can have very long life cycles. In fact, GSI is still shipping parts today that were designed in over 10 years ago. But customers do want to have dual sources. They'll set their specs, and they look to qualify at least 2 vendors for the same part. That kind of keeps both vendors honest and provides some stability for the customer. In some cases, however, there are some very stringent specs, and only one vendor can actually meet them. This tends to be more common at the higher end, where GSI is focused. And in fact, we've heard there are around 7 design wins at Cisco where GSI is the only company in there, so they're sole sourced in a few cases. The higher end chips tend to carry higher prices and as a result, better gross margins. A chart here of GSI's gross margin history since 2007. They've historically generated around 40% gross margins, which illustrate, we think, that it's not really commodity business. The DRAM industry, which is a bit more of a commodity by comparison, generally runs in the 10 to 20% gross margin level. So clearly this is different. The drivers for the quarterly variance in gross margins for GSI is really due to mix. Some products carry higher margins, some lower, and it just depends on what's selling in any given quarter. So that is the kind of background. I'm happy to take any questions on the SRAM market in the Q&A. So before we go further, I want to describe the thesis, and then through the rest of this presentation, I'll try to provide some additional details and kind of fill in the blanks. As I mentioned, the strong balance sheet, the history of profitability, despite it being a semiconductor company, provides us a bit of comfort and we think an element of safety. The major overhang that has been weighing on the stock has recently been removed. The company won an International Trade Commission lawsuit against Cypress. And as you might have guessed, Cypress is the big bad Charlie from our pizza story. Based on today's steady-state business, we think the stock is pretty cheap, especially given that a major risk has been resolved. But if it was just a cheap stock, it really wouldn't be as interesting to us. We want to find companies that are cheap and also can return to very profitable growth. And we think the exciting part of this story here is that GSI has the potential to nearly double its market share over the next 18 months. And we think that the pie may also get a little bit bigger as well over the next few quarters and years. So this could lead to something like 100% in revenue growth. In addition to that, they also have launched a new product, this LLDRAM, which we'll get into, which could provide an additional 50% growth over the current run rate revenue stream over the next few quarters. So as a result of the growth opportunities and the operating leverage in the business, we think that they can get back to $25 million in operating income in fiscal year 2014. And do note that they're on a March fiscal year. So they're in the middle of their fiscal 2013 right now. And then beyond that, we think they can continue to grow their EBIT to the mid-$30 million range within a couple years. And while we do think that 25% operating margins is possible, we've tried to cap them at 20% just to bake in some level of conservatism. A fair valuation, we would think, for a company with these characteristics would be in the 10 to 12 times enterprise value to EBIT range. And using that multiple on the 2014 numbers gives you a $13 stock price. So compared to the 5 3/4 price today, we think there's plenty of upside left in the name. So what's the market missing here, and why is the stock down? As I mentioned, Cypress sued GSI for patent infringement, which came out in June 2011. They not only sued GSI, but Cypress also sued several distributors and customers of GSI, who many of them were customers of Cypress as well. Seems to be an odd maneuver for Cypress, but they're known to be a pretty aggressive and can be ruthless company at times. In addition to that lawsuit, from what we've heard, Cypress may have engaged in a bit of a smear campaign to try and ruin GSI's reputation. Things like telling customers, don't use GSI, we're going to bury them in this case, things like that. And TJ, the Cypress CEO, has made some pretty strong comments on the company's earnings calls, which you could read in the transcripts. It seems that Cypress really viewed this lawsuit as an opportunity to put some doubt in customers' minds about GSI. But GSI clearly believed that they had done nothing wrong and spent $10 million over the last 12 months in legal expenses defending themselves and their customers. So they paid for their customers' legal defense. And that has weighed heavily on the profits of the company. In addition to that overhang, the telecom equipment market has been soft over the last few quarters, and that's put added pressure on GSI's revenues. So the net result is that for the last 7 quarters or so, GSI's revenues have been falling. And the chart shows here kind of when the Cypress lawsuit came about and the decline in the revenues. The revenues have fallen from around $22 million a quarter to about $16 million a quarter. So it's clear the combination of the Cypress lawsuit and the smear campaign and telecom weakness has put some pressure on the revenues. As a result, earnings have come down, and with that, the stock price has fallen as well. Stock has fallen from about $8.50 before the lawsuit to a low of about $4 in May 2012. And as I mentioned, it's rebounded up to 5 3/4. And Cypress was extremely vocal about how they were going to win this case. And I think when you combine the revenue declines, the comments from Cypress, with GSI being a small-cap technology company, it's really not hard to see why the stock came under a lot of pressure and more or less has been forgotten by the market. So that's why the stock had been under pressure, but the case has progressed and at this point is more or less resolved. On October 25th, 2012, the administrative law judge, Charles Bullock, who is a senior judge at the ITC, delivered his initial determination, which found that GSI did not infringe on any of Cypress's patents. It was a clean sweep victory for GSI. As a result, a major risk to the company has been removed, and the stock reacted immediately. It's increased around 28% since that ruling. However, we do think there's still a lot of upside. The market, we don't think, is fully appreciating the secular growth opportunity for the company in terms of market share. So here's where the pizza story that I started to talk with takes on real-life meaning. Samsung decided they were going to exit the SRAM market and leave $150 to $200 million of revenue on the table. The reason they're exiting is that they're really focused on the NAND memory and the DRAM business. They own fabs, and when you own fabs, you want to pump a lot of volume on there. They're also focused on cell phones, as we all know. So yes, the smaller SRAM niche has really not been worth Samsung's time. So they're exiting the market. The revenue stream that Samsung has today, we think has been concentrated more in the telecom and the military markets. The announcement was made several months ago, but the final shipments from Samsung are going to be at the end of this month, calendar year 2012. We do expect, however, that the inventory that Samsung is shipping today will remain in the channel through at least the middle of calendar year 2013. But once that inventory is cleared out, the customers are going to have to look for alternative providers to meet their needs. One of the things we love to see and look for in some of the investments we make are capacity leaving a market. As long as the pie itself doesn't shrink, the remaining players will all benefit, and we think GSI is really in the best position to win market share. So going on to the next slide, the market share potential. This chart tries to put some numbers to our assumptions about the market share growth opportunity. We used a $900 million total addressable market as the base assumption. Now, just as in the pizza story, we think Cypress is effectively capped around 50% of the market share. From conversations we've had, we get the impression that customers don't want to give too much power to any one vendor. They want to maintain a dual source environment. Furthermore, we've heard some rumblings that Cypress really didn't make many friends by suing their customers when they sued GSI. So we think there's some chance that Cypress could be in a bit of a penalty box for some time, but they're not going away. We just think on the margin they're not going to win their fair share of the Samsung revenue that's up for grabs. As a result, the majority of the Samsung revenue is likely to fall into the hands of GSI and, to some extent, ISSI. We think GSI wins more than integrated silicon solutions because the concentration of revenue is in GSI's strongest markets, telecom and military. ISSI has recently come out with some designs at the higher end, but they don't really have many reference designs. And from what we hear, customers are going to be more interested in going with a proven entity. We don't see any new entrants into this market for the foreseeable future. So over the next 12 to 18 months, GSI has an opportunity to pick up a lot of market share. And the market share growth does not require a huge leap of faith here. It doesn't require GSI to do anything different than they're already doing. They simply need to execute and win the designs. And now that the Cypress lawsuit overhang is gone, there's no fear, should be no fear in the minds of customers regarding where GSI stands. So you put it together, it looks like GSI could add $70 million in revenue to the business over the next several quarters, which is nearly 100% growth off the current run rates. So we think that the market share growth opportunity here alone really makes this a compelling investment. But there is more. The company has rolled out a new product, which they call LLDRAM, or low latency DRAM. It's a bit of a hybrid between the SRAM products and the DRAM products. It's great for applications where price tends to be more important than speed, but speed is still important. It's much faster than DRAM, but much slower than SRAM. However, it does cost less than SRAM. So there will be applications where this makes sense to use. And today, the total addressable market of this is about $200 to $300 million. Micron is the dominant player with most of that market share, and it's, from what we understand, the most profitable product at Micron. But customers do want a second and a third source, and GSI has been developing a product for a few years and are now in the final stages of qualifications with a handful of customers. They announced one win earlier this month, and we think more will follow. So we think that the market can also grow once GSI enters, as more customers will be willing to use this, since there would be a reliable second source. The company has talked about eventually generating $10 million in revenue per quarter from this product line within a couple years. So there's a lot of growth opportunities available for GSI over the coming years. This next slide is the revenue potential. It's kind of an estimate of what we think is possible for the business. In 2012 and an estimate for 2013, there's some declines due to underlying weakness in the telecom market, and the Cypress smear campaign definitely had an impact pushing revenues down. By fiscal year 2014, we estimate that they could see some strong growth from market share, as we talked about, coupled with a modest rebound in the underlying market, and some revenues from the LLDRAM. And that continues through to 2015 with additional market share gains, growth in LLDRAM, and a further increase in the market. Now, the market growth, underlying market growth for 2014 and 2015 are really higher than the long-term expectations because the soft telecom market we've had over the last 2 years has created, we think, some pent-up demand. As we mentioned, the SRAM market is probably a slow growth market over time, although in the higher-end chipsets where GSI is strongest, it may have stronger growth. Now, I'm positive that these will not be the numbers that they're going to report. We're really not looking to be too precise here. We'd rather be generally right than precisely wrong. So we could be off on any one of these numbers by a decent margin, and the result will still be favorable for GSI and for the stock price. So pulling it all together into a long-term operating model, we think The business grows to $200 million in revenue over time, driven by market share, the underlying market, LLDRAM, and potentially some other products. The gross margins should remain in the 40% range, mid-40s. The company is very efficient with their R&D and SG&A spend, which really allows them to deliver the 20% EBIT that we talked about. There are minimal CapEx requirements for the company. They don't own a fab. They outsource all their production. And so, as a result, 90% plus of the operating income flows through to the free cash flow line. In the appendix, I have a chart that shows the cumulative operating income and the cumulative free cash flow since 2007. So what's the company's moat here? Admittedly, this is not a business to buy and hold for the next 20 years. I have a hard time figuring what this company is going to look like that far out into the future. However, we think the meat of the performance for this company is going to come over the next 2 to 4 years. Over that time period, we really think the company has some durable advantages. First, they're focused on the SRAM market. Unlike some of their competitors who get involved in the more commodity DRAM products as well, GSI is focused on the high-end applications. And the LLDRAM product is thought of more as SRAM than DRAM. That focus on SRAM and higher-end designs really provides a strong operating model with high margins and allows them to be very fast to market. One of the competitive advantages we think they have that has a longer runway is their R&D operations. So 74 out of the 137 employees that they have are engineers. The company is incredibly efficient with how they develop new designs. They optimize the use of photomasks, which tend to be a very expensive component in the manufacturing of semiconductors. They develop a library of base designs, and when they need to create a more specialized and customized part for a Cisco or for an Alcatel or a Juniper, they use that base design and then only have to design a few additional layers on top to deliver that specific customization. So it's very efficient. The company's proven that they're incredibly fast to market. They have several firsts. And in fact, one of the reasons Cypress, we think, got very upset is that GSI was faster to market with a Sigma Quad family of chips, which today are the fastest SRAMs in the market. As we noted before, given their current positioning and market share, we think they have an advantage over the larger players to pick up market share that would be meaningful to the company. They're focused on the higher end, and the more difficult designs puts them in a strong position to win the higher valued sockets and the newer designs. And then lastly, we think the management team has proven to be key for this business, given how they've grown over the years in a competitive environment and maintained profitability during soft patches. So with small cap companies, it's really not enough to just have a good business. We think you have to have a good management team that knows how to grow and knows how to scale. And one of the things we also look for when we're investigating a company is the insider ownership and any recent insider transactions. And we think GSI scores very well here. The insiders control around 25% of the company, which today is worth about $34 million. We think this represents the vast majority of their own personal net worth. And while they do own some options to get there, the majority of the stock they hold is owned outright. And in July 2012, the head of sales, Didier, made an exercise 30,000 options at a strike price of $4 when the stock was at $4.68, and he held on to the shares. So we think that was a good sign. The company's done a remarkable job. The management team's done a remarkable job navigating through this environment and maintain profitability despite these declines in revenues over the last few quarters. They've built up a lot of credibility in the marketplace, proving they know their stuff and winning that Cypress case. And we feel they've been pretty good stewards of capital over the years. So today the company's sitting, as I mentioned, on $90 million of cash and cash equivalents. About $75 million of that is sitting onshore. So you don't have this issue where the cash in the U.S., can they use it for buybacks? Can they use it for paying dividends? It's sitting in the U.S. And one of the things, with a company that has as much cash as they do relative to their market cap, one of the key determinants of the returns to shareholders over the next few years is going to be what they do with that cash. Clearly, they don't need $90 million to run this business. In fact, $26 million of that cash is sitting in long-term bond investments. So it's clearly an overcapitalized balance sheet. But we think that the reason for that, the companies wanted to maintain a very strong balance sheet while they were fighting this lawsuit and dealing with the attack from Cypress. They needed to show customers they were here to stay. But it's much better to have an overcapitalized balance sheet than an undercapitalized balance sheet, and we think that there are plenty shareholder-friendly actions that they could take over the coming years. They have been smart about buying back stock. They've had two repurchase programs in place since 2008 and have already purchased about $14 million of stock already at prices, we think, less than $5 a share. We've had numerous conversations with them about their buyback philosophy, and we are of the mind that the only time and the only reason companies should buy back stock is when it's trading for less than it's intrinsically worth. We're not really keen on buybacks to just reduce dilution, and they seem to agree with us. One final item that could be a use of cash is the potential for M&A. The company has commented that they are interested in adding small complementary technologies that have a high level of intellectual property and carry high margins, which they could sell into their existing telecom customer base where they have strong relationships. We don't think that they're looking to spend more than $10 or $20 million. And given their history and the direct ownership of the management team, we're willing to give them the benefit of the doubt should they find a deal that they like. Ultimately, we think that as they progress through the next couple of years and as the business grows, they are going to look to return more capital to shareholders in one form or another. Finally, the important risk section. There are a few key risks that we should discuss. The first is that the ITC could overturn that initial ruling and decides to rule against GSI. Now, this would clearly be a negative, but we don't think it would be a death blow. The products that were in question represent only 15 to 20% of GSI's revenues, and there are other mitigating factors that should they end up losing this case, that would not make it as bad as it would seem. That said, we think the odds of a ruling being overturned are extremely low. The many industry participants we spoke to all felt that Cyprus had a weak case, and with the judge who made the ruling being senior judge, we think that the full panel will not look to overturn that. There is serious customer concentration here at GSI. It's important to note Cisco last fiscal year represented about 40% of the revenues. That number was down to 27% over the last 6 months due to some declines at Cisco greater than at other customers. But we believe that the relationships that GSI has with Cisco are very strong. GSI paid for Cisco's defense in the Cyprus lawsuit. And furthermore, we think that the relationship is strong because Cisco did not make any side deal with Cyprus to try to get out of the case. They stood by GSIT and were there fighting the case with them. The pricing environment with Cisco has been normal. It's very unlikely that Cisco is going to simply drop GSI. But we do think that over time, the percentage of revenue from Cisco should decline. As GSI grows the market share, they will grow at other customers faster than they'll grow at Cisco, and the concentration should come down. So places like Juniper, Alcatel, Huawei, ZTE, among others, should be good opportunities for GSI to reduce that customer concentration. Continuing on with the risks, they're obviously subject to the cyclicality of the telecom equipment market, but the company has proven they can both grow and remain profitable through the cycles. There are some alternative technologies out there. One of them is owned by Mozy, a public company. Our due diligence has uncovered some serious concerns about that technology, even if it gets off the ground. And this risk itself, should it ever manifest itself, is really many, many years down the road, not something that's going to impact the company over the next 2 years. And lastly, the company, if the company were to make a poor M&A decision, spending something like $50 million on a bad deal, would clearly not be good for the stock. But we think that they're going to do the right thing given how much stock the company itself owns. In conclusion, we think that GSI possesses a very attractive opportunity for capital appreciation over the next 12 months. In full disclosure, it's the largest position in our fund. Our average price is around $4.70 per share. Now, buying the stock today, even though it's up a little bit, you are getting a company where the legal risk has been meaningfully reduced and that major overhang has disappeared. With Samsung's exit, GSI is in pole position to pick up large amounts of market share. And while the business is still tied to carrier spending on telecom equipment, we think that the good portion of this revenue growth is going to be more secular due to that market share opportunity. And then when telecom spending returns and the pie gets a little bigger, it's going to be an added win to GSI sales. So from today's level, we think the business will also see expanding margins from that revenue growth. And even if you don't think they're going to pick up much market share, the stock's not that expensive on current run rate earnings. But if they do deliver on some of that growth that I've discussed, we have the potential here for a triple win of higher revenues, higher earnings, and a higher multiple, leading to what we think would be a dramatically higher stock price. So I'll end the talk here with the stock chart. As you can see, the stock has started to recover, but we think it has a long, long way to go. So that's the end of the presentation. I appreciate the opportunity to speak with you, and thank you so much, and happy to take any questions.
Anthony, thank you so much for a very compelling presentation. Anyone who has questions for Anthony, please log into our conference website at valueconferences.com, where you may write in questions in our online Q&A area. Anthony, I have a few questions myself. Just wondering, first of all, on the lawsuit, if you could just give us a bit more sense whether you think we've seen the last of that lawsuit, or could there be anything more to come back to bite us here?
Sure. So the case at the ITC, as I mentioned, the initial determination was made. The final determination has not yet been issued. It goes to the full committee at the ITC. Cyprus clearly appealed the initial determination, just as you would expect they would. So we're waiting, and it could come in January or February. I think February is the last. It has to be out by February on that final determination. We think that the odds are just very low that will get overturned. Judge Bullock is a senior judge at the ITC, and we don't have the exact statistics on the number of his cases that have been overturned, but we think it's fairly low. You can go on the ITC's website and log in and see the documents. It's case number 792. You need to get a login, but you can go on there and look at all the documents. Some of the documents about his initial determinations are still blacked out. They haven't been fully released, so we can't see everything that went into his decision. But you can see the Markman hearing and the claims construction, and in that case, you can see that GSI kind of was all in favor of GSI. They had 6 of the claim construction went in favor of how GSI wanted them to be defined, 2 of them in terms of how Cyprus wanted them to be defined, and then 2 of them that were a blend. So, all along there were indications that it was kind of moving in GSI's favor. The case, we think that they didn't find GSI to infringe because they didn't. Simply the patents that Cyprus have, GSI's designs did not use the technology that was in there, and there was plenty of prior art that could be relied upon. So, the odds of the case being overturned, we think, are very low, and so that's what that is. Now, there are still 2 other lawsuits that are outstanding. Cyprus had initially sued GSI in district court. That was then moved to the ITC because the ITC has a faster track to get to a judgment. So that case is still out there. It's in Minnesota, I believe, and we don't think that the odds are very high that the district court will rule differently than the ITC. I mean, the ITC is really experts on patent infringement, and we think the district court kind of looks to them and will rule similarly. When Cyprus sued GSI, GSI then initiated a lawsuit for antitrust practices on the case of Cyprus for some activity they had made, forming a group to come up with a design and categorically excluding GSI from that group. So, that Cyprus tried to get that case thrown out, but the judge said no. So they're in the middle of discovery right now. And should GSI win that case, the monetary reward is quite significant. Our personal take on the remaining 2 cases is that GSI does not win the antitrust case, and Cyprus does not win the district court patent infringement case, and they just kind of go away. There will be some, so the legal expenses will remain for some time, but at a much lower level than what they had been at the ITC. It's a very expensive thing to deal with an ITC lawsuit.
I think related to the legal expenses, I think you mentioned a figure of about $10 million, which is not insignificant relative to GSI's market value. I'm curious whether now that they won the ruling and if that gets upheld, presumably they could get that back Is that right?
No, so unfortunately, the ITC, there's no monetary damages that can be, or rewards that can be had. It's really Cyprus was suing to try to get an injunction placed on GSI's products, which represent about 15 to 20% of GSI's revenue. And GSI's defense was simply to not have that injunction in place. So there's no way for them to get back the $10 million they spent on that case. And there's no monetary damages that Cyprus would have earned. It's simply they would have had an injunction upon the importation of GSI's products. But so the $10 million is gone. I think Cyprus. It's really interesting the timing on when Cyprus launched that lawsuit. I don't know that they ever really thought that they were going to win anyway. I think that they saw Samsung exiting the market, and they said, let's put some pressure on GSI by suing them, making them spend $10 million or more on a case to defend themselves, and put doubt in the minds of customers so that we can try to win more of that market share and prevent GSI from winning it. And them not winning that case, we think, put a little bit of egg on their face. So we'll see how it plays out. But I think it was clearly a positive for GSI.
Interesting, and I guess you did mention the large cash balance at GSI. Certainly that adds some light on perhaps the rationale also for keeping so much cash. Just curious, how do you then expect this to evolve over the next year or two in terms of the capital allocation, presumably if this lawsuit's gone away and that risk recedes? Can you give us some sense of what you expect then from management in terms of uses of that cash?
Sure. So they had a buyback in place throughout this lawsuit, and they were aggressively buying stock through a 10b5-1 plan. So there were no blackout periods. They just had a price, and the folks at Needham were running that buyback for them. So they were buying back stock prior to the lawsuit being ultimately resolved. They had a lot of confidence, and Didier, the head of sales, did a exercise and hold months before the case was resolved. So they clearly had a lot of confidence that they were going to win the case. I think they continue with the buyback, and maybe can be willing to pay up a little bit on that price. I have not talked to them about any sort of special dividends, though that could certainly be on the table. I think they'll probably try to do some kind of M&A. If they can find a deal that works for them, that is a $10 to $20 million technology that can't come to market by itself just because it's a small private company, but because GSI owns it, maybe refines the technology, can bring it to their customer base, that could make the market for that product work. That they'll look to do that. So, I think they like having a strong balance sheet, but I do think over time, as we get beyond this market share growth period, they will be more apt to doing returning capital in some form or another. We don't need $90 million to run the business, and they don't need $90 million to do an M&A deal. I think they could operate just fine with $30 million of cash on the balance sheet, doing a $10 to $20 million deal and returning the rest to shareholders.
Great. Just lastly on the Samsung exit, if you could give us some more details around that. Just seems to me that the timeline around when that inventory gets consumed, how do you assess that? And a question as to why, as a customer, one would be buying that inventory if Samsung is going to be out of the market. Why don't we see a switch perhaps already to GSI? How do you see that?
So I think there's a few, it's a good question. I think there's a few ways that plays out. So if you're a customer and you're nearing the end of life of this product, you're not going to want to spend the time or money to qualify a new vendor. So what you're going to do is you're going to buy enough inventory from Samsung to take you through to the end of the life of that product, right? So that's one of the factors. Now, on your new design that you're coming out with, you're clearly not going to use Samsung, but that new design, that new product is not yet out yet. So you'll qualify a Cypress, a GSI, and ISSI for that new product, but for the existing one that you're selling that's nearing its end of the life, you're just going to buy enough inventory of Samsungs and hold it until you reach that end of life. In other cases where maybe you're a year or so out from nearing the end of life of that product, do you maybe just go with the sole source with the remainder of who's left? So let's say it's a Samsung and GSI are dual sourced at Juniper in a Juniper product line. Samsung goes away. Juniper could just go sole source with GSI for the remaining period of that product's life, or Cypress or ISSI, whoever is the second source at that point. And then the new product that they come out with, they'll look to dual source. So that could be the other scenario. And then the final one is a product that has a much longer life ahead of it, and it would make sense then to run through qualifications to bring on a second source. And so if you think about it today, there are far more likely scenarios where Cypress and Samsung are dual sourced together than Samsung and GSI, just by the virtue of the fact of the market share that Cypress has. So on the margin, when Samsung exits and somebody looks to qualify a new vendor, they're going to look to GSI or ISSI because Cypress is likely already there. So we think that the reason why you don't just do an immediate flip of the switch for situations where you're going to need to qualify someone new is that the qualification process is timely. It takes time. The customer needs to spend money qualifying whose ever part they're looking to qualify, and that just takes time. So that's why Samsung didn't just shut off the lights. They gave customers a long enough time period to hopefully get to a point where they can qualify other vendors, and so that's why we think it doesn't just. That's why we think it hasn't happened. The market share shift hasn't happened already, and why it's going to come over time.
Great. Well, we'll leave it at that. Anthony, thank you again so much for your time and the insights on GSI. Very compelling idea, and we look forward to following the progress there. Thank you.
It was my pleasure. I appreciate the opportunity to speak with you.